Hey guys, welcome to Stock Talk with Mike. So we just wrapped up a pretty eventful month in the markets with a lot of headline news throughout the month of March around the 10-year treasury yield increasing, concerns around inflation, interest rates rising, and seeing a bit of a market rotation out of some of the really high valuation growth and tech stocks in particular. And honestly, I've had a very busy month myself, doing a lot of buying. I picked up some shares in some new companies that were new positions for me. I also added to a number of positions. So I was very active throughout the month of March. So I thought it'd be a good time to just have a look at, after the dust settled in March, where my portfolio sits currently as far as my 10 largest holdings. And I'm going to start with 10 and run through to number 1. And just let you know what I've been up to with these positions and what I think the prospects are for the future. So if you like this kind of content, please consider subscribing to the channel. It'd be also great if you'd like this video. There's actually been a lot of changes to my top 10 largest holdings in my portfolio over the last month or so. And I'm really excited about the way the allocation of these stocks is looking in my portfolio right now. With the sell-off we've seen in some of the higher valuation names with concerns around future inflation, it's allowed me to accumulate shares in some of my highest conviction names that I hadn't previously had a chance to build out positions in. So I really like the way it's looking. Some of my highest conviction names are now where they should be, more heavily weighted in my portfolio. These are companies I think are most likely to grow exponentially over the next 5-10 years. So I'm really excited about that. There's still a few positions I'd like to build out a little more if we have continued pressure on the market. But overall, I'm really happy with some of the recent investments I've made and how my portfolio's shaping up. So I'm also going to be referencing this logbook, a little bit old school, but I like to keep everything in this logbook as far as every trade I make. I write notes in here, my investment thesis, why I buy certain stocks, every move I make, and maybe some mistakes I make for I go through each year and I look at some of the bad trades or maybe stocks I sold out of that I shouldn't have, and I write my biggest mistakes I made in here every year. And I find this really helpful tool to keep me accountable. It's just more enjoyable too after looking at a computer screen all day with work and then also with a lot of my stock analysis. I just like to do that. So just recently looking here, this is some notes I made on my current holdings, looking at some of my growth stocks from a valuation perspective, looking at their price to sales, their price to earnings ratio, their forward price to earnings ratio, and seeing where they stack up after a bit of this market rotation, seeing which ones are still quite expensive from a valuation perspective and which ones have come into where I think they're actually of good value right now. Just kind of trying to understand which stocks I might see continued downward pressure in, which might have buying opportunities, and which ones maybe are good opportunities to buy right now. So that's something I've been looking at quite carefully lately, is some of the valuation of some of my high flyers. So with that being said, let's get right into it. All right, starting with number 10 of my 10 largest positions in my core portfolio is CrowdStrike Holdings, ticker CRWD. They are the cloud-based endpoint cybersecurity company, by far and wide, I think, the leader in the cybersecurity space. I think it just makes sense to have exposure to this space. Cyber threats aren't going anywhere, and as we see more cloud adoption, CrowdStrike's only going to become more relevant. The one issue with, I think, cybersecurity companies is always evolving technology, and there's a bit of a history of them sort of coming and going. But CrowdStrike is by far and wide the leader in this space, and they're just gaining market share like crazy, growing triple digits fast, and really, really acquiring some just great big player customers. Really like CrowdStrike. The only potential knock on them is because they're so successful, they've traded generally at quite a rich valuation. So no surprising during this rotation out of some of these high valuation names we saw in March, this one sold off quite heavy. This is a company I've owned for a couple years now, and I had taken some profits along the way in 2020. You're going to hear that's a bit of a common theme for me, as the market was so frothy in 2020, and I had so many stocks move so aggressively to the upside that I was definitely trimming some of these positions, building a cash position that I've almost fully deployed here in 2021, as we've seen a sell-off in some of these names. This is one of those that I did add back to build out a full position again in my portfolio to be now where it's 10th largest. So it is all-time highs around over $240 a share, I believe, and traded down to around the mid 170s, and it's currently back to around 187. And the valuation has come in quite a bit. It's currently trading around 30 times 2021 sales, so that's quite a bit better than it was, and it's still expected to have revenue growth of over 50% here in 2021. So I expect good things to continue from CrowdStrike. Next actually is a 10B, and I have this one in here because it's not actually a position from my core portfolio. This is in my speculative portfolio, but because it's been on such a run over the long term, it's actually grown to where it's actually quite a large position for me, and it's actually probably bigger than my CrowdStrike position, and that's JMIA Technologies, ticker JMIA. They're the Africa-based e-commerce player. They've made some real strides towards profitability in 2020, where they're now much more lean and mean. And I'm really excited to see their quarterly reports for 2021 because they're going to be against much better comps with this new asset-light model. And I think they're going to look really good. And I'm really excited to see because I think we are going to test the old all-time highs of earlier in the year of over $65 a share here in 2021. Currently, it's trading around $38 a share. And I did nibble some more here in the mid 30s, building back out that position I had as, again, yeah, this is one of those names that I had been trimming, taking some profits, a lot of profits actually out of in 2020 as it was just this meteoric rise. I think I had some shares on a cost basis of $5 that went up over 1,200% in 2020. So this was by far my best performer in 2020 for me. And despite this big sell-off, I've locked in a lot of profits in JMIA, and I have no plans on selling out of my position. I plan to keep a core position in JMIA for the long term. All right, next is number 9. My 9th largest holding is Shopify, ticker SHOP. They provide e-commerce for small business, and I think this is just a great e-commerce play. I really like Shopify, and this is a relatively new position for me. This is the 1-year chart, which actually still looks pretty good, but you can see we did have a pretty steep sell-off in March of 2021. And I opened a new position and actually bought on 2 or 3 different occasions as it continued to drop to improve my cost basis in Shopify and have a decent sized position built out. I would actually like to add more to my Shopify position and have it higher allocation in my portfolio. So we'll see if we get continued sell off, but it actually ended last week quite strong actually. So we'll see what we get out of Shopify. I just think this is a company that's positioned to be much, much larger than it is today. I believe around a $300 billion market cap currently. I could easily see this being a $1 trillion company one day. And this is a company that I definitely want to be holding for the long term. All right, next on my list, my number 8th largest position is Palantir, ticker PLTR. This is a relatively new position for me. Obviously, they just came public last year, but it's also sold off pretty hard. I added some more shares here, just over $20 a share, almost $21 a share or so, and really helped improve my cost basis on this one to around $22, $23, somewhere in there where it's currently trading. And this is, again, one of those companies growing at about a 40% revenue growth currently, trading about 28 times 2021 sales. Its earnings, the PE ratio is not that great as its profit margin is not that good currently, but I see that improving as we move forward. And I'm really excited to see them move more into private industry, private enterprise, and out of just these government contracts. I think there's just going to be endless market in big data analysis, and it can save companies so much money. And they have so many case studies where they have paid for themselves 10 times over by making companies more efficient by using their services. And why wouldn't you pay for a product that's going to save you more than it costs? And that's what Palantir provides. And I just think it makes a lot of sense as there's just more and more data out there to be analyzed. I think Palantir just makes a lot of sense. Next is Tattooed Chef. This isn't a stock I've actually covered in any videos, but I know a lot of YouTubers talk about it, and it's, I guess, just not the most exciting company in the world. They're primarily a frozen food company. Ticker, by the way, is TTCF, but they also do a lot of vegan meals. And I don't have a lot of food company exposure other than another spec play I have as well, Plant & Co., which is, I think, a pretty interesting play. But this one, for its growth prospects, really high growth in the consumer space. And I definitely don't have a lot of consumer products in my portfolio to begin with, and definitely not a food company. So this adds some nice diversification for me, and I think it's a pretty interesting growth story. So I have been picking away at some Tattooed Chef during this sell-off, getting in at like $17, $18 a share on a bunch of purchases, and I've been happy with that cost basis. So be interesting to see what the future holds for Tattooed Chef as a public company. I'll be really interested to follow to see how it goes. Number 6 is Pinterest, ticker PINS. So Pinterest has fallen quite a bit off the all-time highs of $90 or so, traded down to closer to $60 a share during the sell-off, and I'd been aggressively buying. This was a new position for me. This is a company I had wanted to get into for quite some time. I think the valuation here is still pretty attractive. I think last couple trading days there in March, it actually shot up quite a bit, right? So now it's at $77 a share, but it's still only trading at around 18 times expected 2021 sales, which isn't too bad, and has a forward PE of around 55. But for incredibly high growth company, expected to have revenue growth in about the 100% range in 2021, I think the valuation is pretty attractive here. So this is one of those names that kind of got sold off along with a lot of the high growth tech stocks, even though I think its valuation is fairly strong compared to some of these other high growth names. So I really like Pinterest, relatively new position for me, but as I bought, it continued to drop. So I built out that position pretty fast to where it's already the 6th largest position in my portfolio. Next, number 5 is NVIDIA, ticker NVDA. This has been a really long-term hold for me. I owned it for 4 or 5 years now, and just been a phenomenal performer. Looking at the 1-year chart here, you can see it's kind of traded sideways for the last 6 months or so, but it's just been an absolute beast, and its valuation is still pretty attractive as well, trading about 14 times 2021 sales with a forward PE of around 35. This is a stock that I had taken some profits in 2020, not a lot. I just trimmed it back a little bit, but I did add that back here during this sell-off that we had in the high 400s, I believe. So NVIDIA is a stock that I plan to hold for the long term. This obviously being the chip company that is in so many interesting industries. Obviously, it's probably one of the purest play AI plays as well. So if you want to have exposure to artificial intelligence, NVIDIA is probably the way to go. Really like NVIDIA, really good growth story. Still expected to have over 30% revenue growth in 2021. 4th largest position now is Unity Software, ticker U. This is a position that I picked up shortly after the IPO, and it did really well in 2020, but I had a pretty small position that had run up, and I never really had an opportunity to build out a position until here in 2021, where we've seen just quite the bloodbath in the name. So it was traded as high as $170 a share and traded down into the 80s. So I bought as low as, I think, $88 a share on the way down, and have now built up quite a large position to where it's one of the larger positions in my portfolio. So they're the 3D gaming engine for developers for building 3D ecosystem games and apps, both for console, but also mobile games and PC. And they also 3D in other industries as well. So into the movie industry, into engineering, architecture, and that as well. So really interesting play, and a company that is just really executing well. I think it's going to be like a long-term growth, steady Eddie growth story, growing revenues in the 30 to 40% range for the next 5 years. I think this is a company you can buy and hold for the long term. Really like Unity Software, and I have a fully built out position in Unity, not looking to add any more shares, even if we see a bit further pressure on the downside. Next, in my third largest position, this is a position that I've really aggressively built out as of late with the market sell-off, and that is C Limited, ticker SE. They are the Singapore-based Southeast Asia e-commerce play, and they also are, so that's called Shopee, and then they also have a whole gaming components platform as well, and they are just a revenue growth beast, growing like crazy. It traded as high as $280 a share, and I had a small position in 2020 that I just run up and never really had an opportunity to buy to, so I've taken full advantage of the big market sell-off. It's currently trading at $236 a share, so quite a bit off the lows we saw a week or two ago of around 200 or so, but it's currently trading around 14 times sales. I think decent evaluation for a company that has about 80% revenue growth projected for 2021. So it's kind of the mid-range as far as valuation, but just this has been like a triple digits growth story as well. And I think there's still a lot of runway ahead for C Limited. And yeah, I have a fully built out position now that came pretty quickly during this market sell-off. Number two, my second largest position is Teladoc Health, ticker TDOC. They've got a lot of flack on CNBC lately. Their names constantly thrown out there as these high valuation, high flyer growth names. And honestly, I think a bit of it's miswarranted. So this is the 1 year chart. And actually, I should mention, so Teladoc is the telehealth leader, virtual healthcare provider, completely holistic, provide for psychologists as well as regular doctor visits as well. And they are by far the biggest player in the space, but also the fastest grower. So I think Jim Cramer on CNBC was knocking them that there's more competition in the space now. Well, that's nothing new. Like obviously they were going to face competition. I know Amazon's even moving into the space, but honestly, Teladoc is also the fastest growing. So unless I see huge market share taken by some of these other small players, I'm not too concerned about it, because when you have the biggest player in the space also growing the fastest, that tells you that they're winning. And I like to own the winners. That usually is a successful model. This is the 1 year chart. You look, it just shot up like crazy at the beginning of 2021, and we've lost almost all those gains in the last month or so, and now looks relatively flat over the last 1 year, despite having triple digit revenue growth in 2020. So obviously that's really helped them grow into their valuation. The sell-off combined with the fact we're trading at basically 1 year ago levels, that they're now, with this sell-off, they're trading around 13 or 14 times 2021 sales. So that is fairly reasonable. That's not cheap, but it's not like nosebleed levels. We were seeing companies 50, 60 times sales. Snowflake, way higher than that even, right? So I think Teladoc has really come in here and gets a bad rap for being a high growth company, trading at a rich valuation, where its valuation really is not that bad now, and they're still expecting 82% revenue growth in 2021. So I think they're really well positioned here, and I do not think they're just a COVID play. Their revenue growth was massive before COVID, and they're predicting it to be massive coming out of COVID. This is a long-term growth trend. People aren't going to go away from virtual medicine. This is here to stay. And I still like Teladoc, and this is a company that I definitely added to some more during this sell-off. I've been in Teladoc for quite some time, 3 or 4 years now, since it was around 30 some odd dollars a share, currently trading at $182 a share. My largest position is Square, ticker SQ. I really believe in Square in the long term. This recent sell-off did not faze me a bit. I have a ridiculously low cost basis, around 20 some odd dollars a share in Square, maybe even lower than that from 2017. But I actually nibbled on some more here during this sell-off in the low 220s, I believe. And yeah, it's the largest position in my portfolio, right where I want it. And I think this is one of those companies, you look at their valuation and you look at sort of the top line numbers, it's difficult to evaluate just the way they report their Bitcoin revenue now. So when someone buys Bitcoin on the app, that shows up as full revenue, and then it's also expensed on the expense side. So you can't just look at the top line sales. You have to look a little deeper than that. But they are trading around 7 times sales, if you back 2021 sales, sorry, and then if you back Bitcoin out of that, it's more like 10 times sales. But they have a forward PE of around 113, so it's not that cheap from an earnings perspective. But this is a company that's still growing like a weed. They have about 50% revenue growth expected for 2021. And I think something people aren't thinking about at all is that they're a bit of a reopening trade. We're talking about the Cash App and the growth with their Bitcoin and selling stocks on the Cash App and everything else. And we've almost completely forgotten that they're basically the frontline register for small business. That they have the chip readers and the whole ecosystem for small business payments in person. So think in-person vendors at festivals and fairs and whatnot, right? Which has just been hit super hard. And despite that, they've had such a resilient business where they've shown massive revenue growth. And I think when you combine that with those other businesses coming back online, those other revenue streams, you're going to see huge things from Square. So I'm really excited to see how that plays out. And Jack Dorsey's moving into all kinds of other things, obviously. And there's been some plays in the music industry as of late. So it'll be interesting to see how some of those other deals work out. I don't know exactly what he has planned there. So that Jack Dorsey is, of course, their CEO. So we'll just have to wait and see. But Jack Dorsey is just such a visionary. He's one of those visionary CEOs that is kind of the front leading edge. He was one of the first companies to put some of their balance sheet into Bitcoin as well. Others have followed suit. So this is really one of those really innovative companies that I'm happy to own and has performed incredibly well. So there you have it. There are my 10 largest positions in my portfolio. And I don't know about you, but I actually really enjoyed March in the market. It actually created some real, validation for me as to why I was taking some profits on the back half of 2020 and allowed me to aggressively buy some additional shares and buy some stocks on my watch list. And obviously at the beginning of March, when we started to see the big sell-off, it was a bit discriminate, right? Like every high valuation or tech stock was selling off. And there was a lot of blood in those names. But honestly, what I saw in the back half the last couple of weeks is a more discerning market. So there might have been some pain still in some names, but I was seeing some in the green, some red, much more typical market. I would say what we saw the back half of 2020 was more the unusual, atypical market, right? Where just everything was up every day. It was kind of frustrating because it won't last forever. And it just makes sense that we'd see some downward pressure. When you hear people saying like, oh, just buy a SPAC, it's near $10 because they only go up. There's no easy money in the markets, and that's what it was seem like. So I think this all makes a lot of sense. It's nice to have a bit of a discerning market back and a bit of a stock pickers market, and start accumulating more shares in these companies slowly, and they'll continue their rise over the long run. So hopefully you didn't feel too much pain, and hopefully you're able to make some good decisions and pick up some companies during a bit of a downturn we saw in the market. So that's what all I have for you today. Thank you for watching and happy investing.